Hello, this video is for FIN 1003, Chapter 7, and the topic is a quick review of the dividend discount models. So the first thing that we learned with regards to stock valuation using the one-period model is that the stock value at time 0, P0, equals the present value of the dividend at the end of the first period plus the present value of the stock price at the end of the first period. So recall the formula for present value. Present value equals the future value divided by 1 plus r to the n. And in this case, we're seeing a different nomenclature, KE, sometimes the cost of equity. So we see KE or R, it's just different nomenclatures. It's the required return on an investment in equity, okay? So again, when we're doing stock valuation, it's really, we're just looking at the sum of the present value of the dividends plus the present value of the stock price at some time in the future. And this is no different than when we do the pricing for a bond. The price of a bond is the present value of all the future coupon payments plus the face value of the bond at maturity. So calculating the price of a bond and stock valuation models are very similar. And so again, we started with the one period model. And recall the practice question for that was this one here, where using the one period valuation model, assuming a year-end dividend of 11 cents, an expected sale price of $110, and a required rate of return of 10%, the current stock price would be what? And it's giving you the multiple choice questions. And here I brought up the solution, and the solution is in Blackboard. Let's just bring up the calculator and show how we do it. So we're just doing a present value calculation, and the dividend, D1, is 11 cents, and the P1 is $110. So we're going to add the two together, $110 plus 11 cents. This gives us $110, 11 cents. And we're going to divide by 1.1. Present value equals future value divided by 1 plus r to the n. 1 plus r in this case is 1.1. So I'm just going to divide by 1.1, and the correct answer is $100.10, $100.10. So the correct answer is C. Okay? The next thing that we looked at was then the general model. And the general model is basically where you're given more than a one period. So you're given the dividends for 1 period, 2 period, 3 period, 4 period, more periods than 1 period. We're going to use the general model. And the value of the stock today is simply the sum of the present value of all the dividends plus the present value of the stock price at some point of time in the future. So recall the example that we used in class was from the CFA Institute Investment Foundations program. And the example was Volkswagen. Volkswagen is a German company. They're going to pay a dividend of $4 per share at the end of 2012, $4.20 at the end of 2013, $4.50 at the end of 2014, and the investor estimates that the stock price of Volkswagen will trade at 150 euros at the end of 2014. I always like to draw the timelines. So it says here at the end of 2012, 4 euros. That's D1. D2 is 4 euros and 20, and D3 is 4 euros and 50. And the price at P3, because it says 150 at the end of 2014, end of 2014, D1, D2, D3, so that would be P3. The P3 price is 150 euros. So how do we calculate the value? Value P0, or sometimes we see it as V0, is, so we're using the general model here, D1, D2, D3, P3, and we're doing the present value calculations divided by 1 plus the cost of equity or required rate of return. And it says here the investor wants to earn at least an annual rate of return of 14%. So that's our discount rate. The KE or the R is 14%. D1, present value of D1, present value of D2, present value of D3, plus the present value of P3. Okay, so you can see that's 1 year, 2 year, 3 years. That's what we're using in the denominator. And so when we add that all up, the correct answer is 111 euros, 0.02. That's the estimated stock value price, or sometimes we call that the intrinsic value. Okay, And we learned how to do that on the calculator. We can use the cash flow functionality, cash flow, second, clear work. And the cash flow at time 0 is 0. I'm going to arrow down. C1 is the first dividend, 4, enter. Arrow down, frequency 1. C2 is the second dividend, 4 euros, 0.2. Hit enter. Frequency for that second dividend is only once. So we arrow down through that. And for the third cash flow, we're going to add together, because you see year 3 and year 3, 150 euros plus the 4 euros.5. So that's going to be 154.5 for my cash flow 3. Hit enter, arrow down, frequency on that is 1. So now pay attention. What I'm going to do is I'm going to click on the NPV key. And for the interest rate, that is 14%, because that's the KE or the R. It's the rate required by the investor. I'm going to hit 14, enter, arrow down. When it says NPV, I'm going to click compute 111.02, 111.02. Okay, so that's the general model. The example was Volkswagen from CFA Institute Investment Foundations program, and we showed you the calculator keystrokes using the cash flow functionality. Okay, so the next dividend growth model that we looked at is the Gordon growth model. So remember, these are different models, all calculating what we think the value of the stock price to be today. So the first one was the one-period model. Then we looked at the general model where we had more than 1 year's dividends. Now we're looking at a Gordon growth model. And we use this model when we can make the assumption that there's the expected growth rate in dividends becomes constant, okay? Constant growth rate, which means the rate doesn't change at some point in the future. So in the future, the dividends are expected to grow at 5%. Well, they're going to grow constantly at a growth rate of 5%. When we can make that assumption, we can use the Gordon growth model for stock valuation. And the formula is here. V naught equals D naught, the dividend today, times 1 plus G. That's so what does D naught times 1 plus G equals? That equals D1. That's the dividend at the end of the first period. D naught times 1 plus G. Divided by R minus G. R is the required return on investment in equity, and G is this constant growth rate. So again, P naught equals D1 over R minus G, or sometimes we see that as P naught equals D1 over K minus G. Sometimes we see it as V naught equals D1 over R minus G, okay? So therefore, when you can, if that growth rate in the starts to become constant at some point in the future, like for example after 3 years, then P3 could equal D4 over R minus G. You see what we're doing here? We're using the Gordon growth model, but we're using it to calculate P3. We're using it to calculate the stock of the price 3 years later. So recall, if we go back to that Volkswagen example, we were given the 150 euros after 3 years. But if we can calculate that price at P3 if we know that the dividend becomes a constant growth at the end of 3 years, okay? So where are we headed with this? Well, as I said, the key is that we can calculate PN at any time in the future as soon as we can assume that the dividend growth rate becomes constant. So if you look back up to this formula, the general model, we can now use for PN, we can use the Gordon growth model. PN equals dn plus 1 over R minus G. We can use the Gordon growth model to calculate PN. So from the Volkswagen example, we had D1, D2, D3, and then we took the present value of P3, the 150 euros at after 3 years, and don't forget we take the present value of it, okay? But now we can create a two-stage model, or a type of question where we combine the Gordon growth model and get you to calculate PN, and then add up the present value of the dividends and the present value of PN, and we calculate the stock price. And when we do that, the dividend growth rate is at different rates for the, for example, for the first 2 years, the first 3 years, then it goes to a constant rate. We call that a multi-stage model. So we've gone from the one-period model to the general model where all the information is given to us. We've learned about the Gordon growth model, where once the dividend growth rate becomes constant, you can use it. And so we can combine the general model and the Gordon growth model, use the Gordon growth model to calculate PN at some time in the future. Okay? So therefore, the stock price, again in summary, is the present value of all the future dividends plus the present value of that stock price at some time in the future. Okay? So let's move on now to an example. Okay, so we're going to work through the example of this multi-stage dividend discount model. So first, let's look at the data and then explain why it's multi-stage. So the current dividend, D0, is $5. Growth is expected to be 10% a year for 3 years and then 5% thereafter. The required rate of return is 15%. So we need to calculate the intrinsic value, or the P0. But they're not giving us the price of the stock at some point in the future. They're just giving us the dividend today. They're giving some growth rate on the dividends and the required rate of return. So what do we need to do? We need to use the Gordon growth model. So P0 equals PN equals DN plus 1 over R minus G. So what we're going to do is we're going to calculate the price of the stock, P3, using D4, okay? But I think we can understand that a little bit better if we draw the timeline. So this is time 0. So we're going to call that P0. Sometimes we see it as V0. That's time 0. And we know that the dividend here, D0, equals $5. That's given to us in the example. So this is going to be year 1. This is going to be year 2. This is going to be year 3. I'm going to draw a little bit longer line so I can do more writing. And this is going to be year 4. So we're going to need D1, D2, and D3. And it says here that growth is expected to be 10% a year for 3 years. So D0, $5 times 1.1 is going to give us our D1. So let's just bring up the calculator. And so it's $5 times 1.1. And we've got our dividend for D1 equals 5.5. And so reading the question, growth is expected to be 10% a year for 3 years. So for the second year, we're going to multiply that by 1.1 again. And so bring up the calculator, 550 times 1.1. Our D2 is going to be $6.05, okay? So D2 is 6.05. So just, I know someone like to do their numbers in rows, and I'm using columns. D2 is 605. We're going to multiply that by 1.1 to get our D3. Okay, so multiply that by 1.1, and we've got our D3, 6.655. I like to keep the decimals. Equals 6.655, and that's my D3. Okay, I can label it like this too. That's my D2, and that's my D1. Okay, D1, 5.5, D2, 6.05, D3, 6.65. Aha. So after 3 years of a growth rate of 10%, it's 5% thereafter. So if I multiply D3 times 1.05, I'm going to get my D4. So my D4, just bring up my calculator, 6.655 times 1.05, and I have a D4 of 6.98775. And yes, I like to use 5 decimals, okay? So therefore, now we've calculated the dividends. Now, we're not going to take the present value of this D4. That's the important thing to understand. It says after the first 3 years, the growth rate is becoming constant. We need that D4 because what we're going to calculate is we're going to calculate the P3 equals D4 over R minus G, okay? And we know R is 15% and G is 5% thereafter. So P3 is going to equal D4, which is 6.98775. And we're going to divide by 0.15 minus 0.05, 0.15 minus 0.05, which is 0.10. So just going to bring up the calculator, 6.98775. That's the D4 divided by 0.1. And so we have a P3. P3 equals $69.8775. Okay? So now we've calculated the dividends, and we've calculated P3 equals $69.8775. So let's just check our solution here on the Word document, and let's see if we're right. So now what we need to do is to get the P0, we need to do the sum of all the present value of the dividends plus the present value of that P3. Okay? So that's what we're reviewing here. So you can see there's the D1, 550. Yeah, we had it right. D2, 6.05. That's right. D3, 6.655. We're going to do the present value at 15%. So we divide D1 by 1.15. That gives us the present value D1, present value D2, present value D3. Then we use the P3 we calculated down here, D4 over R minus G, 6.98775 divided by 1.5 R minus G, 1.15 minus 0.05, because that's the required rate, R minus G, 5%. And we get 69.8775. That's what we've got, but we're going to have to do the present value of that. So and that's going to be divided by 1.15 to the power of 3, which is the same thing as here, 1.52087. Because what are we doing? We're doing the present value D1, present value D2, present value D3, plus the present value of P3. Okay? So 1.52087, 1.52087. Now, I want to show you, you can do this on the calculator using the cash flow functionality again, which is a lot less algebra. So let me just bring the calculator over here, and we'll just use the dividends from the right-hand side because maybe it's a little bit neater than my handwriting. So cash flow functionality, second, we're going to clear our work. CF0 is 0. Arrow down. C1, that's the first dividend. That's 5.5. Hit enter. Frequency is once. Arrow through it. C2, second dividend, $6.05. Enter. Frequency on that second dividend once. Arrow through it. C3, now we're going to combine because it's the third cash flow is D3 and P3. So it's 6.655. That's the D3 plus the P3 we have down here, 69.877. Oh, too much. Arrow back. 75. Okay. So that equals $76, which is the third dividend, 6.655 plus 69.8775 gives us 76.53. So we're going to hit enter, arrow down. Frequency on that is only once. So what do we do again, folks? We're going to hit NPV. The required rate of return is 15%. So 15, hit enter, arrow down, NPV, hit compute, 59.6786, 59.6786. So here it is with the algebra. But once we knew the D1, D2, D3, and the P3, in fact, you don't need to use all the algebra to do the present value calculations. We can use the cash flow functionality on the Texas Instruments BA2 Plus. Okay, we're going to finish this video by doing two quick practice questions. Recall this is from CFA Level 1. This would be a 90-second question that you'd have to do on the test. So an analyst gathers the following data about a company with double-digit growth rate that is expected to continue for 3 more years. The current year dividend per share is $2. So let's draw our timeline. That's going to be time 0. D0 equals $2. Okay, dividend not. And we're going to have to look at the end of year 1. That's going to be a 30% growth rate. Year 2 is going to be a 30% growth rate to get to year 2. And then there's going to be a 20% growth rate to get to year 3. And after that, in year 4 and beyond, it's going to be at an 8% growth rate to get to D4. Okay, so we're going to need to calculate D1, D2, D3, and D4. Okay, so let's just bring up the calculator here. Okay, so we've got our €2 dividend. That's D0. We're going to multiply that by 1.3 for our D1. So D1 is going to be €2.6. multiply that by 1.3, 30% growth rate for D2, which is 3.38. Then it's at 20% growth rate, 30% year 1, year 2. Now it's 20%, so multiply by 1 plus G, which is 1.2. And we've got 4.056 for D3. Then it's going to, after that, it's going to grow at 8%. So we're going to multiply by 1.08. And we've got our D4 of 4.38048. Okay, just squeeze that in. So let's just check down here. Oh, this is a solution. D1 is 260, D2 3.38, and D4 4.06. We've got 4.056. And for D4, you can see it's 4.06 times 1.08. Okay, so we know that to get the P naught, it's going to be the sum of the present value of the future dividends plus the present value of the stock price at some point in the future. So we don't have the stock price here. We're going to have to use the Gordon growth model. And how do we do that? We're going to calculate P3 equals D4 divided by R minus G, because D4 growth rate year 4 and beyond becomes constant at 8%. Okay, so we can calculate P3 equals D4, which is 4.380. Let me bring up the calculator and see that again. 0.48, and we're going to divide that by R minus G. R is 0.15, and G is going to be 0.08. Okay, remember, here's our R, cost of equity capital, and our growth rate once it becomes constant is 8%. So therefore, it's going to be, just bring up the calculator, 0.15 minus 0.08 is 0.07. So I'm just going to divide it by 0.07, and we're going to have P3 equals 62.57829. Okay, a little bit different than the number here, probably because we're using a little bit more rounding in our calculator, but don't worry, it's going to be close enough. Okay, so again, that P3 was going to be 4.38048 divided by 0.07, just to write it out, and that's going to give us 62.5789. Now remember, to calculate P naught, we're going to have to calculate the present value of that, so we're going to divide that by 1.15, which is our required rate of capital here, but it's at P3, so it's to the power of 3. Okay, and that's going to give us the present value of the stock price. So again, now that we have our dividends though, and we've got our stock price, we can use the cash flow functionality on the calculator, which is a lot easier than cranking our way through all the algebra. So let's go to our cash flow. Second, we're going to clear our work. Okay, so cash flow, 0 is going to be 0. We arrow through that. The first dividend is 2.6. Hit enter. Arrow down. Frequency is once. Cash flow 2 is the second dividend, which is 3.38. Enter. Arrow down. Frequency is once on that. Cash flow 3, 4.056. That's the last dividend. And we're going to add in P3, so it's plus our 62.57829, and that's going to give us our last cash flow, 66.63, which is D3 plus P3. We can hit enter on that. Frequency is once. Click the NPV. Our required interest rate is 15%. 15. Enter. Arrow down. NPV. Hit compute. 48.6297. 48.6297. Okay, is what we've calculated. So we're saying it's A, and indeed 48.68, very close, 48.62. Sometimes you see a little bit of rounding, and that's why they always say here, company's value per share is closest to. Well, we're closest to A. Sometimes there's going to be some small rounding difference, but definitely there's no doubt that 48.6297 is closest to 48.68, And here's their calculation, a little bit of rounding error, okay? So again, that's a 90-second question. Not bad. Step 1, calculate the dividends, do the present value of the dividends, calculate P3, do the present value of P3, add them all up together, and you get P0, okay? So that's a pretty easy practice question. So we're going to finish this video with the last practice question. So an investor evaluating company's common stock for investment has gathered the following data. Earnings per share 2012, $2.50. The dividend payout ratio is 60%. So that's how we calculate the dividend. The dividend for 2012 equals the earnings per share times the payout ratio, okay? Companies earn earnings, and they share the profit with owners of the company through dividends. One share, one dividend. Okay, so that's $2.50 times 0.6, and the dividend is 2.5 times 0.6 is 2012 dividend, $1.50. Okay, $1.50 is our 2012 dividend, and that's going to grow. So here we're going to show that's $1.50, 2012, and it's going to grow at 25% for 2013, 2014, and after that it's going to grow at 5%. That's where our growth rate is becoming constant. So we're going to have D1, we're going to have D2, but our D3 is already growing at a constant growth rate, so therefore we can use the Gordon growth model and calculate P2, which is D3 over R minus G, okay? And our required rate of return is 12%, and our growth rate at that point is going to be 5%. So P2 is going to equal D3 divided by 0.12 minus 0.05, okay? So just bring up the calculator, and 0.12 minus 0.05, yes, I'm sure most of you can do that in your head, good for you, 0.07. So P2 is going to equal D3 divided by 0.07. All right, so let's just look at, we have $1.50 for our 2012 dividend. It's going to grow by 25% for year 1. It's going to grow by 25% for year 2. And then after that, it's going to grow at 5%. So let's just bring up the calculator here and calculate my dividends. So it's $1.50, 2012 dividend, times 1.25, and we have a D1 of 1.875, okay? And our D2, we're going to multiply that by 1.25, and we've got a D2 of, well, if I want to keep all the rounding, I'll just write it down here. D2 equals 2.34375, okay? And we have our P2 then. So we're going to have to calculate our D3 first. So our D3 is going to grow at 5% after that. So it's times 1.05. Our D3 is going to be 2.46094. Okay, so P2 is D3 divided by R minus G, which we've calculated over here to be 0.07. So just keeping the calculator up, D3 divided by R minus G divided by 0.07. And we've got a P2 of 35.15625, okay? So now what we need to do is we need to calculate the present value of the dividends and the present of D1 and D2 and the present value of the P2, okay? So again, we can use the cash flow functionality of the calculator, hit cash flow, second, clear our work, CF0 is 0, arrow down, C1, our first dividend, 1.875, that's our D1. Enter that, arrow down, frequency is once, cash flow 2, our dividend 2, 2.34375. And we're going to add the P2 in this case. So this question is a little bit shorter, which is a little bit easier. Nice one to end on. So we're going to hit plus 35.15625. That's going to give us D2 plus P2, 37.5. We're going to hit enter, arrow down, frequency on 1. Hit NPV. The discount rate we're going to use is 12%. The investor's required rate of return is 12%. So here we're going to hit 12, hit enter, arrow down, NPV. We're going to hit compute. We get 31.56888. Okay. 31.57. The correct answer is B. So let's just bring up the calculator here, slide it over and check, that was my handwriting. Let's just see how we did here. So the correct answer is B. Dividend per share is 31.57, 31.56888. It's bang on. So is the present value of D1, present value D2, plus the present value of the P2. Okay. Again, so nice little summary here. To calculate the, this is using the two-stage dividend discount model. To calculate the value per share is the present value of the future dividends plus the present value of the stock price at some time in the future. In this case, it was at the end of 2 years. And that's the end of this video that became longer and longer on the dividend discount model, but that is a full and comprehensive review, starting with the one-period model, the generalized model. Then we learned about the Gordon growth model, and we put the Gordon growth model into the generalized model, and that became we could run a two-stage or multi-stage model. So fantastic, good work. I hope you work through that and learn something. Thank you very much.